The word hybrid means to bring two different elements together into one. We start seeing hybrids more often than ever. A lot of different businesses and professions are blending old world and new world techniques in medicine. I've seen doctors who are using clinical and synthetic medicines along with holistic and natural. Cars, we've seen a blend or a hybrid of using gas and electric. In nature, every time I turn around, there's some kind of new oodle. They're mixing every single dog with a poodle because poodles don't shed. Maybe you've seen this one before. This is a liger. It's a mix or a hybrid between a lion and a tiger. This one I actually saw one time at a zoo. It's a zonkey. That's right, a zebra and a donkey. Of course, we have a zorse, a zebra and a horse. And then, of course, the best hybrid of all time is the world famous mullet. You know, party in the back, business in the front. So I've heard this term hybrid a lot more. It's becoming more popular as the new reality has opened the door to new options. And this is also being noticed in the investing world as the methods that people use continues to expand all the time. But most of these styles can be broken down into one of two broad categories, and that is passive or active. A passive approach is basically designed as a buy and hold to track the market. And a passive approach stays invested for long periods of time, but it also can fear volatility. It can fear when the market starts to take a downturn and go against what it's intended to do. Whereas an active approach is designed to move a little bit and to align with market conditions. It's designed to add value and to potentially outperform the market. In fact, it embraces volatility and it uses volatility to the advantage of it. And really, there's been a long running debate between these two camps. You have your passive people and your active, and they've been saying my way's better and my way's better. But the truth is, we all know that, especially when it comes to investing, there's no one method or approach or whatever that can be all good. And there's not one that can be all bad. There's advantages and disadvantages any way you look at it. So when you look at these two categories, let's look at, from a market standpoint, you have either a bull market, a bear market, or a sideways market. And statistically, each of these approaches have their own personality based on the market that is going on at the time. So for instance, in a bull market, a passive investing approach tends to get in early because you're already invested, and then basically aligns with the benchmark and is able to perform because the market's going up. An active approach might get in a little bit late because maybe they don't have a confirmation until the new trend has already started. But then once they're in, then they have the ability to add some positions or a strategy in a way to potentially outperform during a bull. Then when the tides turn and we start hitting a bear market, then the opposite is true for the passive. Because you are fully invested at all times, what was once good during the uptime, it can now be a negative thing. And so when you stay fully invested as prices are dropping, then you tend to underperform during a bear. This is where active approaches can shine because they have the ability to often sidestep a down market to protect, or even use a position or a strategy that can potentially even profit when prices are going down and markets are in decline. Then when you hit a sideways markets, neither of these really do that great. Passive is probably a winner between the two, and that's because one, it doesn't take as much time to manage. You basically stay invested and let it do what it does. You don't have to worry about what's coming around the next corner. Whereas an active approach is trying to figure out what trend are we heading into. So there's sometimes a tendency to overtrade and potentially to even underperform for an active approach. So what you'll see is, based on the market that's going on, each of these have their advantage and disadvantage. Now, the exciting thing is there's been so many advances that have happened in our industry that we believe have really kind of changed the game. First of all, transaction costs, trading costs have drastically been reduced, even eliminated for stocks and different types of funds. So the argument against transaction costs within an active approach is potentially no longer even an issue. Number two is these trading platforms. The logistics of actually managing an active approach has changed so much because the new programs and platforms are so efficient and really geared towards active strategies, so that has made things a lot easier. The other thing is the occurrence of black swan events. You know, a black swan event is something that basically comes out of nowhere by surprise that you can't even plan for. You know, like September 11th in the early 2000s, the financial crisis of 2008, and of course the pandemic in 2020. Uh, we're seeing more and more of these all the time, and those can cause havoc with a passive approach. So when you look at those factors, a lot of people who were only in the passive camp have come over and said, you know what, maybe an active approach can help um, improve the overall results. And then on the other side, a lot of people who have been in the active camp are starting to see new funds that have come out, alternative funds that have new benefits and new strategies that are actually designed to align with the needs of the new reality, and are not like the traditional funds of the old, which there's some exciting opportunities with that as well. And so they've started to look at the passive side and said, you know what, maybe we should combine some of these benefits and work these things together. So what's happened is you've seen a blend or a hybrid of these two approaches starting to come together from an investing standpoint. Now, I've gotten pretty in depth with the information on this, but there's a reason for that. It's critically important. This is a part one of two video announcement on something that we're getting ready to roll out. And so it's really important that you understand the foundation of what we're doing. In the next video, I'm going to take you behind the scenes and give you a lot more details into the specifics on how we are using these approaches that I covered and enhancing them in a way to really benefit the current models that we have, why we're doing it, and what that means to you. We'll go through each of them individually and show you some really cool information, which I'm excited about. So until then, if you have any questions, please let me know. Any feedback. Otherwise, until next time, please stay safe.